Hmm.
When we flip from monthly to 12 months, it's going to get rid of any seasonality. And the reason why I wanted to do this, I wanted to show you, for example. So if we go back to 2018, and I only went back 5 years here, but if we go back to 2018, you can see this curve here. It's kind of a flat line that was going up around 4 to 5% a year. And then COVID happened, and then what did we do? We went from here to here. Look at the angle of that line. That's too fast for any markets to sustain over time. So, and if we go back further in time, so remember, this really makes it pronounced, is that if you go to 12 months, that gets rid of any seasonality. So we can eliminate that from any factor. And look how steady we were from 2012 to 2020. And look at the slope of this line, and then look at COVID, right? This is not sustainable, right? And look at pre-recession, we were going up pretty quickly, and then we were coming down, and then we were flat for a while. But then 2012 to 2020, this is your 4.5%, 5%, right? So this is what long-term, what we will see. This here is not sustainable. And if you look at what we're doing right now, and I know it's kind of hard to see, but we're starting to get back to this type of slope, right? So we're going to control, hopefully go back, and you can see it if I zoom in. This is more like pre-COVID, right? So we are getting back to a pace of home price increase that is sustainable over time. So that's not a bad thing, right? So when you get rid of the seasonality, it's kind of hard to tell where we're at. But if you go to 12 months, you can kind of see what prices did and what they're doing now. So I just wanted to show that as an example. So if we go back to the monthly, we're still higher year over year, maybe dip for 2 months and then come back to positive. So look at price per square foot. So price per square foot, we're at $219 last month. And again, this is all of Charleston, but $219, that's the highest we've ever been, right? So price isn't the highest we've ever been, but price per square foot is. So why is that? That's because of all the work people are pouring into houses, right? They're making that same, even if it's 1,000 square foot house, they're making that 1,000 square foot house more valuable by updating the bathrooms and kitchens and fixing it up. So our price per square foot set a new high in April of this year. And again, if we go back in time, let's go to the rolling 12 months, you can kind of see the same sort of trend. This type of line, too fast, returning to kind of a normal trend. So, we'll watch this over time, but that's the best way to look at it, is getting rid of the monthly.
Do you think that'll go down come winter?
I mean, I think we're probably, you could see what happened last winter, right? We were at a high in August, right? So May was 217, August was 217, and then we drifted off, and January was 205.
I'm just curious, if you do the yearly trend, will we start seeing that even out and then start curving the opposite direction?
I mean, I think it's going to be stable. If we go back in time, and let's go back in the years, here's your price per square foot, right? So pre-recession, recession, steady growth, out of control.
Normalized.
Let's see what happens here. I mean, I don't think, because you still have a lot of contractors out there doing work on houses.
Oh, I agree.
And if we zoom in, I think you're going to see something similar. And let's go look at the monthly. We kind of sagged off, but this is kind of the seasonality that we see. And I think we're going to kind of be in this range for a little while, and then kind of try to find a way to head higher. But I don't think you're going to see a major drop off, just because I think you still have a lot of people renovating houses and still doing that. And the sales price is going to stay, at least steady, and then head higher over time.
Mm-hmm.
If we flip so here's percentage of original price. So this is very interesting. So we were 100 from February of 2021 to August of 2022. So we were, half the houses were selling for 100% or higher for this whole period of time. And then when the rates jumped, we fell off pretty quickly, right? So we got down to 96.5 in January, but what was that? That was Thanksgiving to Christmas contracts, right? So we dropped off pretty significantly. And if we look back in time, you know, again, this is looking monthly, we were at this 100% back pre-recession too. We fell off the cliff in the recession, got back to a norm of about 98%, ran it back up, and then we have this wild swing, which look at these wild swings back here. We've had this wild swing here recently. And if we zoom in, so I mean, we got down to 96.5 just in the last 4 months, we've gone back up to 98.8. Now, if you look at traditionally, you will see the inverse of seasonality in this curve too. I mean, we lost any seasonality in here. None of this made any sense. But if you look back at 2018, we started the year low. We hit spring high, and then we fell off in the summer and winter, right? So we're going to return, you know, look at January, we're 97.1 up to 98.5 in April. This is even more pronounced. We were at 96.5 up to 98.8. We're going to peak out this in the next couple months, I think. You know, I think by May or June, we're going to see what we normally would see on the seasonality. We're going to peak out and then kind of fall off again. Whether we fall this low or not, I would be surprised. I think this was an over exaggeration of what was happening with the interest rates. You know, so some wild swings in here, but I think we're going to peak out at that 99% range and start to go back down in the winter like we traditionally would do on seasonality. If you look at the average, so the average, you know, we were at, look at that, May of last year, we were at 101.2%. Because, I mean, you had some houses selling at 105, you know, percent. But I mean, I've seen some closings lately that were 10% above list. So, I mean, we're back into those moments of, you know, crazy. And it's not quite as high, right? We're at 97.3 on average, not 101.2. But you can see the seasonality in this too, right? Go back to, forget COVID, look at 18 and 19. You have those seasonality, right? Where you're going to peak out in the spring, summer, and then fall off in the winter. So, you know, we're going to peak out again and fall off to some degree in the winter. So this should follow that same trend. You know, and if you look at, yes.
Right. Would you say also part of that steep decline was because people were still way overpricing?
Well, and this is correct. Remember, this is original list price. So people just kept pricing higher and higher and higher as sellers. And this is the adjustment period. This big fall off here and this recovery, I think this is everybody figuring it out. Yeah. Right? People still overpricing in here and it comes down. And then people realize, ooh, I can't overprice to sell and it's coming back up. This, I think these wild swings are people adjusting, because you can see we didn't have wild swings in here, right? It was kind of more a moderate swing, you know, within 1% really, right? Here we've swung from 101 to 95. I mean, over 6% swing. And I think this is people figuring out the market, the higher rates, you know, not, you know, the market's not going to go up 15% a year. So this is what we're trying to figure out right now. And if you go to the rolling 12 months, we're still falling off, right? So if you go to the rolling 12 months, we're still dropping. Now, once we get to, you know, but you can still see we're much higher than we were back in 18 and 19 on a rolling 12 months, we're still higher. So I think what you're going to see is until we reach this point, remember this May, we're not going to be at 101.2. Right? We're not. It's not going to do that. So comparison year over year, we're still going to have a tough comparison year over year because we will be lower. But once we hit this period next year, you know, October, November, December, I think we could be higher. So it will start to, this chart will stop the drop off and we will find a bottom at some point. Where we find the bottom? I mean, realistically, let's go back in time before COVID. I mean, Maybe we're finding it between 96.5% and 97%. We're just not there yet. So the rolling 12 months, I think, will still come down until we reach the fall, and then we will find some normal levels. And again, if we look at this, this is showing us we're, at 98.8, we're actually higher than we were pre-COVID. So this is all an adjustment period we're going through, trying to figure out how to price houses correctly off the rip, basically at the beginning. Days on market. So again, look at this wild swing here. We were down to 3 last spring. We jumped to 25. We've fallen off the cliff to 8. Again, this is the market trying to figure itself out. Now, you look at the seasonality, let's go back to 18 pre-COVID, we would be 30 in January. And in the spring, summer, we get down to 2 weeks, right? 14, 15. So you see this seasonality in 2018, you see the seasonality in 2019. We lost the seasonality in this part of the market, but now we're returning to the seasonality here, the high in January and February, just like back here, and then dropping off much more extreme than what these were. But, we're down to 8, but we will find a bottom and go back up in the winter. So we're just trying to find our new seasonality. And if you go back in time, you can see the seasonality any year. Here's 16, 17, 18. We're just more extreme right now, trying to find a good place. And you can see the extreme in the recession, right? We were trying to figure things out back here. Look at the gyrations. And then this became more of the normal market. Let's zoom in again here. So here's the median days on market, the average days on the market. Again, we were at 50 to 60 back pre-recession, and seasonality in this too fell off the cliff. A little bit of seasonality returning, higher rates made everything slower. So we had 46 days in the market as the average in February. Well, that's, Thanksgiving, Christmas, New Year contract. So, but now we've kind of flipped that back around, dropping again, but we will find a bottom on this as well. But remember, median price, so half the houses are selling in a week or less, right? So once you hit the right price, and again, I know there's unique properties out there, but the typical house, once you're at the right price, you should be selling within a week right now. Months of supply. So here's months of supply. If we look at this one, again, on a monthly, we're at 1.6 months right now. Now, historically, that's still all-time lows, right? Even pre-recession, we never really got below 3. So at 1.6 months, we're still twice as fast as absorption right now as we were pre-recession. Now, at the worst part of the recession, we were at 17.4 months of inventory. So it was 10 times slower than we were in the recession, right? The recession was 10 times slower than we are today, on absorption. So I want to put in perspective, we are still at a bottom that, Market Monitor doesn't go back before 2004, right? So we are as low as we've recorded in this data set. And if we zoom in again, so 1.6 months of inventory. Now we still see the seasonality, right? We lost seasonality in here. It's starting to return again. You can see the seasonality. Now, what's interesting is, we're dropping on months of supply heading into the spring. And if you do the rolling 12 months, we're still increasing on a rolling 12-month basis because we were so low a year ago. But at some point, we will find for lack of better terms, a high on this number. If we look at monthly, right? So we're trying to compare 1.6 months of inventory to last year when we were 0.9, right? So at what point do we start bottoming out? Well, if you look at July of last year, we were 1.7, August we were 1.8, September 1.9. Maybe when we get to this period of time, the year-over-year comparisons, we're finding a place to live for the moment in this range here, which again, 2 months of inventory is still a seller's market by any definition, a strong seller's market by any definition. I know everybody uses 6 months as kind of that dividing line between a buyer's market and seller's market. I feel like it's kind of 4 to 5 months, 16, 17, 18, 19. I don't know, those as my 22 years in the business, that felt as neutral of a market as I can think of. And we were sitting between around 4 months of inventory. So I think if we went to 6 months of inventory, that would feel like a buyer's market all day long. So I think if we get back to 4 months, now, when are we going to get back to 4 months? No time soon. I mean, like, that's way too far out for me to guess. I mean, 1.6 months heading lower. When we get back here, I don't know, years. I don't know. Like, ask me this next year and I still probably won't know. So we are still in a very seller's market environment right now. And it's not changing anytime soon. 1.6 is hyper low on months of supply. And again, if we go to rolling 12 months, again, we might kind of start to crest out around 2, maybe, maybe. I'm not even going to say that. We'll see. Let's go back to monthly. So monthly homes for sale. So homes for sale, again, we've been on this decline, right? Traditionally when January 1st rolls around, we should be increasing on inventory. And again, if we go back in time, look at 18, right? Start the year low, end up in the fall at the high, fall off for the winter. Same thing in 19, start the year low, go up in the spring, summer, fall off. And again, we lost all seasonality with COVID, but if you go back in time, that's the way it is every year. You can see it. And I mean, you have general trends, but it's going to go up at the beginning of the year, right? Every one of these years, it goes higher. What did we do this year? Down, 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 right? So we are losing inventory at a time of year on a seasonality basis where we should be going up on inventory, right? So when you go opposite a seasonal trend, what's that? The market is changing. Right? If you're not following the seasonal trend, that's showing the market is overriding the season. And if we zoom in here, so we're going down on inventory when we should be going up. And if you go to a rolling 12 months, so rolling 12 months, we were sitting on a 12-month average, we were around 6,000 houses for sale in 2018, 2019. COVID happened, we dropped all the way. Our low on a 12-month basis was around 2,000. We started going up, but I think if we zoom in and we kind of figure out what's happening right in here, I think what you're going to see is we're starting to level out again, right? Year over year. And in my prediction, and like, let's go back into the monthly here. So, and I don't necessarily agree with all of Market Monitor's numbers, but it's good for year over year comparison. So April, we're at 2384. Now this morning, we're at 2222. So we're still lower than this, but if we go back to last June and July, you can see we were ramping up very quickly on inventory. Why were we going up so quickly on inventory here?
Mortgage rates.
Mortgage rates, right? They doubled. So what happened?
Sitting.
Yep, there was a pileup of listings that couldn't sell because of the affordability. So we kind of piled up the listings in this period here. We got to a high in October, and then people started figuring out, it's like, okay, well, if the mortgage rate is this, I still need a house. But also you had sellers who said, well, I'm not going to sell, right? So we had sellers hitting that realization. That's like, well, why would I sell and double my rate to buy a different house? So we started going down on inventory. And if you look at last June and July, be at 3,100 in July. I don't think there's any way we're going to be at 3,100 in July, right? So there's no way. I just don't see how that's going to happen. So what we're doing is, when you look at the rolling 12 months, we're averaging still some pretty low numbers from a year ago, but by July, that's going to start to turn. And I feel pretty confident if we're sitting here in July, I can say we have less for sale in July of 2023 than we did in July of 2022. So our inventory will actually be going down again year over year, I think by the second half of this year. So it's just showing is that we have a lack, all this is a lack of motivated sellers. Right? It's just we have the buyers out there that are absorbing houses, but yet we don't have the number of sellers to replace them. So we are definitely on a challenging, path again for homes for sale. Now, are we going to hit March 2022 lows? I don't think so. But we're also much below, let's zoom out. Let's go all the way back, right? We had 12,000 houses for sale in the recession. We have a little over 2,000 today. We have 50% more people living here today than in the recession. So there's no way on a supply and demand basis we're at a even playing field for buyers and sellers at this point. So, just keep all these relative perspectives in mind. It's like 12,000 houses for sale. This is not a bubble. 2,000 compared to 12,000 with 50% more people living here. There's no way. So let's zoom in again. So again, we're heading down on inventory again. Closed sales. So closed sales were off 23.5%. So this is what everybody's feeling, right? It's like it's hard to override the market. And you can see from the peak of June of 2021, we peaked out last year in March of 21-27. I'm not going to say we've peaked, but we're going to peak at some point in the next month or so, and we're going to be below March. So our trend is downward on closed sales, and it's specifically related to lack of inventory, affordability, and lack of motivated sellers to be able to make a transaction. You have to have a seller to have a transaction. We've just run out of sellers. So we're on a down, and you can see where we were at. We're going to be below 18 and 19 probably, right? I don't think, and typically June is your highest closing month. If you look back at 18, June. If you look back at 19, June. Is it going to be this June? I think so, because usually April is a little bit lower than March, so that's not out of the ordinary. But we're going to peak out here in the next month or so on closings. And if we go back to a rolling 12 months, so look at the rolling 12 months. So our peak past 12 months, so when it rolls 12 months and we're looking at June of 2021, it takes from June of 2021 and goes back 12 months. So again, this is the best way to get rid of seasonality. We had almost 25,000 closings. We are at 18 and change, right? So we're back to where we were here.
With no inventory.
But we have no inventory. So does this look like it's about to slow down? I mean, we're still going down on the close count. And again, if we go back to the monthly, year over year, we're still lower. So, that annual count is still going down. And I'll show you in a second where I think we're hopefully can see the end of this downward trend coming. So again, going back to the rolling 12 months, where are we going to bottom? Well, we're bottoming below where we were back here because, our decline is still too steep, but you'll see when I go to pending sales, I think we're seeing where the bottom will end up being. And again, just going back in time, we were doing 18,000 closings prior to the recession. We got down to 7,750. We hit a 18,000 number for years right in here, which seemed to be a good place, shot way up and coming back down to earth. And if we end up back at 18,000 on a regular basis, that's kind of where we started back here and maybe where we're going to end up on this front side. Let's just zoom in again real quick. New listings. So here's our problem, right? We had 26,000 listings in a 12-month period ending August 2021. We have 22,460 the 12 months previous from here. And if we go monthly, again, we're listing a lot less properties this year than we were last year. So remember last year, the rates were still good in here. So people were still listing. What's happened here? We've just lost all our motivated sellers, right? I mean, we were hitting 2,600 listings in a month, and last month we did 1,817. And it's interesting. This is the first, if you look at 2018, 19, 20, 21, 22, you really couldn't see COVID in here, right? We were all kind of hitting lows and highs, and it looked similar. And this is the first year. It's like, whoa, now we can feel what's happening. And it's specifically because when your rates are 6.5%, 7%, and people are locked in their houses at 3.5%, that's taking the new listings away because there's very little motivation for that local person to move unless there's a defining reason for the move. So if we go back to the rolling 12 months, we are falling off a cliff on new listings. And, you know, it was steady growth in here. And then this is the beginning of COVID, right? Where everything shut down and then we grew it. And then we have fallen off. When did rates really change? Like right in here, right? And then what have we done since then? We have fallen off this cliff. And we just need to get to the point where, you know, rates are stable. And if they come down a little bit, this should help this number. You know, you'll get some more motivated sellers to move their equity from one house to another. But this is our challenge right now, is you can't have a closed sale unless you have a seller. So this is the leading indicator of what's happening. If we go back to the monthly here, so here's the bright side, is look at the pending sales, okay? Yes, we are still lower year over year, right? So here's March of 2021, 2,367 pending. 2025 last year, March of this year, 1817. So we are lower year over year over year. However, if you look at the growth that we've had this year to get to where we're at, and you can see when I roll the 12 months, you can see this curve starting to find the bottom, right? You know, it's good to see not this steep of a cliff. We're trying to find this bottom here. And when you look at, if you go back to monthly, the number of pending sales dropped off so quickly last year that I think we're going to surpass this fall. We should surpass where we were last fall. And you're going to start to find the bottom of the pending sales and then start to increase from there. And everything that NAR shows is 2024 should be a better year for the number of transactions 2023. So in this cycle that we're in, 2023, from everything that I'm reading from experts, you know, it looks like that's going to be the bottom on transaction count, and we need to get to next year to start having a positive growth on transactions. So, you know, it's something to look at. You know, if we get a couple more months of data and we can start to find this bottom, then traditionally we should recover somewhat. And if you look back in time, you know, here's pre-recession, hit the high, hit the low, growth over time. And then this was, you know, this is where we couldn't sustain it. So we're obviously going to dip below where we were, but it looks like we're starting to find a bottom here. And hopefully by fall, we kind of flatten this out and we can start to grow. And I'm not saying you're going to see this again. I'm saying like a steady growth again, like what we experienced back in here. But this is the good news out of all this, is that it looks like from a pending sales standpoint, we're trying to find the bottom, which then will relate to the closed sales in the future, right? You can see the closed sales, we haven't seen it yet, right? We're still dropping off, but if the pending sales start to improve, that will a couple months later show in the closed sales. So here's the let me zoom in a little bit here. So dollar volume. So when you look at dollar volume, we're off 26% year over year, but so many of that. So remember, closed sales are off 23%. So dollar volume, we're actually selling less expensive properties because we're off more than that. Now, I also want to keep in mind is that the 838 million we closed last month, that's higher than anything we did pre-COVID. Right? So all relative perspective is like, yeah, that's not $1 billion, $1.2 billion like we were doing here, but it's still higher than what we did pre-COVID. And if you look at, if we roll this into the 12 months and get rid of seasonality, we're still on, I mean, we did $12 billion. So we were averaging $1 billion sales a month, during 2022 for the most part. And then since the high in May of 2022, we've been falling off, and we did 10 billion, but also, so for perspective, 10 billion in sales, what did we do pre-COVID? 7 billion. This is 42% higher than we did pre-COVID, right? So dollar volume for agents is 42% higher. It doesn't feel like because we remember this as a short-term memory, but here's the long-term memory where we were. Now, I'm not saying we're going back down to 7 billion. We're not doing that, but we need to find the bottom on dollar volume, just like we need to find the bottom on pending sales and everything else. But this is a trend that we have to live with for this year, right? So you got to figure out your business this year on, it's not like all of a sudden this is going to V and start going back up. That's not what's going to happen. But over time, we're going to bottom out and start to head higher, not at this pace, but we will start to head higher over time. You also have, if you have the pending, this is really not changed. You hit 10 showings, you should be getting a contract. I mean, it's as easy as that, and it's always been that way. So, you got to hit this range of the number of showings. It is interesting though, if you look at the shows per listing, there was a little bit of gyration in here with COVID. When there was absolutely nothing for sale, you were getting 11 showings per listing. But now the inventory has returned to some degree. You're kind of not back completely to normal, but you're getting about 7 showings per listing. But what's interesting, if I go to the rolling 12 months, you can see that we're still falling off on the showings. It'll be interesting to see if we're trying to find a bottom in here, but we were only getting, and I mean, I think, John and I were talking about this earlier. It's like, during COVID, I had some houses that were getting 40 or 50 showings, and like that never would happen prior to COVID. Right. And the numbers show it's like if you were getting a showing a week, you were lucky, right? You were typical back here. So, we're still way above the showing frequency. And a lot of it has to do, there's nothing for sale, right? So even though we're coming down off that peak, there's still not much for sale. So you're still getting a lot of showings, relatively speaking. Yes, it's not where we were here, but relative to here, we're still getting more showings per listing than we did. So, it's for those of you who haven't been in the business for long, it's all relative perspective. And it's like the last 3 years have been nothing but, abnormal circumstances. But, we will return to some sort of normalcy. But a lot of it is writing this out. And you have to create situations for yourself because the market is not increasing for agent activity right now. It's still on the decline. And I was telling, John and I were talking earlier, and I just perspective for everybody is that if we go back in time and if you look at closed sales or even volume, right? So, volume is how we get paid, right? Look at the peaks and valleys of the last few years, way more. Look at the spread of the highs and lows, right? So, since COVID, here's our low, right? 517 million. Our high was 1.23 billion. So more than double, right? More than double. And that range is just, remember, this is how we get paid, right? Volume. So this is what we're feeling as agents. Like you might have had a great month and then a horrible month. And it's just like, it's all over the place right now. And the range of this is so much higher than what anybody has experienced in the past, right? Even going back here, it's just the range of of transactions and volume is everywhere right now. So we need this to kind of dampen out a little bit, but it's a matter of, and for better or for worse, is that as volume's going down, what else goes down? If real estate agent count, right? It's simple math, right? This is how we get paid. And if you have less money, you have less agents, right? So from here to here, what happened? Increase in agents, right? And there's always a time lag. So this is an increase in agents. What happens when this goes down too long? You have a decrease in agents. So, and again, it's hard to see in here, and I can't really zoom in. But if I go to, and I just, from a personal experience standpoint, let's go pick, I just want to put relative perspective for everybody. Here's Mount Pleasant, if I can find it. So here's dollar volume in Mount Pleasant, right? And that's just, I'm picking this out because this is where most of my business is that here was pre-recession. We hit a peak at $1 billion in Mount Pleasant. We fell off all the way to 400 million. And then we kind of were post-recession, we're trying to find a place, and what was agent count doing? Agent count increased, fell off. And then right in here, when Mount Pleasant went from 500 million to $1 billion, so doubled the volume very quickly, what was happening? The agent count wasn't increasing yet. So who was the benefactor of this period of time here? The existing agents who had their license, right? Volume doubled very quickly. Do you think agent count doubled very quickly? It didn't. So by default, I remember back in 13, I remember agents like, oh, I'm having a great year. I'm like, yeah, it's nothing you did. You're just present, right? You have your license and you're present, and you are the benefactor of the market doing this. And so what happens is that when this stops and it turns the other way, and I don't think, my goal, if you look at the peak, so we're talking, and again, now I'm getting down to who cares about sellers and buyers at the moment? We're talking about agents, right? So as an agent, here was the peak, and that was roughly spring of 06. The bottom was roughly summer of 09. So there was 3 years of declining income, and then a couple years of slight growth, but kind of steady, 2 or 3 years, and then we just shot up. And what did we experience here? We had a couple years of dramatic increase, and then we've been falling off on volume for 2 years, basically, right? June of 2021 was the peak volume in Mount Pleasant, and we've gone down. And let's go back, just so I'm going to go all areas again. So here we go, entire MLS. So here's the entire MLS, right? So volume up, agent count up, volume down, agent count down, steady growth, crazy growth in here. But in the market as a whole, since April of last year, we've been falling off in volume. How much longer we go down? I think we're going to find a bottom at some point, maybe the fourth quarter, first quarter next year. I think we're going to find a bottom. Now, how long we're at that bottom before we start to grow again? I think a lot of it has to do with interest rates, right? If interest rates do come down over time, you're going to have better affordability, so more buyers, but at the same time, you might be having more sellers who are willing to put their house on the market and sell. So what we really need is, if interest rates come down, that will help us find a bottom and start to grow again. But as an agent, you have to make it through this time period of the decline in volume, which is decline in income for all of us, right? And you have to make it to the other side so that when the increase in volume happens, you're present and working and more experienced and ready to take advantage of this growth in volume before agent count returns. Because there's always a time lag, right? If everybody was smart, they would have gotten their license prior to this happening. But what happens is most people start to get their licenses in here. And it's the same thing that happened back here. Everybody, probably there's a lot of people getting their licenses from here to here. Right? There's always a time lag, but it's kind of past that peak. And for those of us that are licensed, it's like you have to survive these times to thrive in these times. Right? So it's just a matter, it's coming. You just have to work hard the next few months, make it through this winter, and hopefully by next spring, I think we will be finding a bottom and starting to work our way out of it and again, it's totally different than sales price, right? Sales price, median price, I feel very secure in our Charleston market, right? We're not going to go down dramatically on price. But from a volume standpoint, we are definitely having some challenges. So, we have to look at, where we're at and the gyrations in the volume. We have to get back to a normal expected volume. And it's still going to be, everything's going to be above where we were back here. It's just lower than we were here. So, anybody have any comments, questions?
No, survival year.
What's that?
It's a survival year. Just
It is like, you're
down for less and less, but
I'm not saying you can't have a great year in
oh,
2023.
for sure.
But for agents, especially for agents who've been around a long time, it's going to be hard to surpass. If you're growing your business, then you can keep growing your business if you're a newer agent. But you have less transactions and less volume competing with more agents. It's a simple math equation of dividing up income, and you have to. This downward trend in income, I mean, this is essentially what we're going through, is this a downward trend in income where it was an upward trend in income in this period. So you have to basically survive this period to make it to the next trend higher. And I'm not saying the trend higher is going to be jumping 20% a year, but we will return to a 4 to 5% growth in price. And if rates come down, the transaction count can come up, because it's not just the growth in price that helps agents on a volume standpoint, it's the number of closed sales. And you can see where we're at right now. Forgetting COVID, we're below closed sales of 18 and 19, right? So we're behind this pace of 18 and 19. So what's going to happen is when we find the bottom and interest rates hopefully settle down, then can we return to this pace? I'm not saying this pace. I'm saying if we return to this pace, you're going to have the effect of a higher number of closed sales on top of higher prices, which then allows the volume to jump, which then if you're around in the business, then you can take advantage of that. But we're trying to find our bottom on transaction count. And then hopefully 2024, can we return to this place? If we do, then that's double positive, because you have higher transaction count and a higher average price, which then gives us the higher volume, right? So yes.
Were you surprised that inventory started to hover around 2,200 thereabouts, just lower in the last 3 to 4 weeks?
I mean, it's everything that's been happening, and we're going back to the homes for sale here. We are definitely opposite of what we would seasonally do with the lower inventory. Now, it feels like we're trying to find the bottom on inventory, because we started dropping at the beginning of the year, and we're trying to find it, but I wrote it up on the calendar today. We're at the lowest Friday that we've had this year. So, because inventory also has that weekly trend, but we're still hitting lows for the year, not overall, because remember we hit 928 last year. But we're still hitting lows, but it feels like the pace of the decline is slowing down. So, and again, I think what could change that is, if anybody listens to Barry Habib, I mean, he's still predicting interest rates are going to come down, right? And where we're at with CPI, if you notice, CPI was 4.9% this last month. So it's the first time we've been under 5 in a while. So inflation, if it gets under control, and the year over year inflation numbers were pretty ugly a year ago. If you look at last May, June, July, and August, they were pretty bad inflationary numbers where a lot of the months they were up 0.6, 0.7%. Well, if we can do 0.2, 0.3% a month, then we could drop inflation by over a point by this summer. And if inflation slows down and the government sees it slowing down, they're going to stop the interest rate hikes. And at some point, if the unemployment starts to go up, they'll start to drop the interest rates. But it's a matter of kind of you need to take advantage of transactions now, because we know the rest of the year is going to be, if you only have 2,200 homes for sale, it's going to be hard to sell a lot of homes just because you don't have enough sellers. I mean, who has more buyers than sellers right now? Right? And everybody raise their hands, because pretty much that's probably everybody, right? So until we reach a balanced market, we don't have enough sellers. And what is it going to take to get sellers? It's going to take, it's not a pricing problem. It's not like they're upside down on their houses. It's just the motivation, the financial motivation to move is gone, because they're giving up their interest rate. They're giving up, their low property taxes, they're in the higher end. If you got high-end homes, they're paying capital gains on those too. So there's a lot of factors going into the financial demotivation of sellers to sell. So we really need to get, I think if rates can settle down in the mid fives, it's a good place for not overheating the real estate market again, but also getting some of these sellers off the fence. I mean, I think that's been the biggest challenge is your sellers, they need a place to go. And if they don't find a reasonable place to go with no inventory, then they're not selling. So we have to get to a point where you can motivate sellers to get on the market. So, all right, well, you gotta hang in there the next few months, right? It's like, again, and I'm not being doom and gloom. I'm just saying it's like this year is challenging. And the rest of this year it's not like all of a sudden June comes around and everything's back to where it was 2 or 3 years ago. It was like, we have to all work hard the rest of the year to get to next year, to get to better rates, to get to higher transaction count. And it will happen. It's just, we got some months to get through.
Yep.
So
Thank God for the volume.
exactly. So, all right.
Thank
Well,
you,
everybody,
Anton.
just go sell one house this weekend. It's all
Thank
good.
you.
That's
All
what
right.
my plan is
Thank
tomorrow.
you, Anton.
Thank
All right.
you.
Have a good
Thank you.
afternoon.
Everybody.
Bye.